This video is going to be about the top 5 most bought stocks on Easy Equities in the month of June. So Easy Equities usually shares a lot of information on their social media platforms, and they posted this screenshot of the top 5 most bought stocks by our community in June, which is the ZAR edition. The 5 most bought stocks were the EC10 bundle, Sasol Limited, Sibanye Stillwater, Renergen, and MTN. So I was curious why these 5 specific stocks were bought in June. So I decided to make this analysis video where I run through the numbers and share the information with you guys. So hopefully this can give us some insight. So if you like this type of videos, feel free to drop a comment down below and share some companies that you would like me to analyze. If there's more than one person commenting a specific company, I might consider doing a video about that company. So with that said, if you learn at least one thing, give this video a thumbs up, and thank you so much for all my YouTube viewers. I really appreciate your support on the channel. So like I said, the first one was the EC10 bundle. And let me just quickly show you, it consists of Bitcoin, Ethereum, Binance, XRP, Cardano, Dogecoin, Solana, Litecoin, Tron, and Polygon. So I don't know most of them. I basically only know Bitcoin, Ethereum, and XRP. Okay. Obviously, I can't really analyze this specific currency or this specific stock because it's a cryptocurrency. So I would invest in cryptocurrency, and I have invested in cryptocurrency, but I only want to invest in Bitcoin and Ethereum. So instead of buying this whole bundle with a bunch of random cryptocurrencies, I would rather invest in Bitcoin and Ethereum specifically. And most of the people that bought this in June bought the stock at a pretty high price, meaning that the chances for them to lose money is pretty big because the price can drop at any moment. I would rather buy that specific cryptocurrency at a low or near a support level. Then you basically know that the cryptocurrency will eventually go up. So if there's one thing that you learn from this video, remember to always buy an asset for the lowest price possible. That would just give you a margin of safety, and your chances to make more money is just bigger. With that said, let's jump to our first stock, and that is going to be Sasol. So I'm going to analyze all of the stocks in the same way. I'm going to try to do it as quick as possible without mumbling and without wasting any time. So first of all, let's jump to Sasol, and we are going to scroll down and click on Insights. So this is a quick insight about the company. Something cool about Stock Unlock, it shows you a quick blurb, which is basically basic information or important information that can help you quickly decide whether it's something that you want to invest in. And it says here that Sasol Limited has negative free cash flow of minus 93 million, which means it is currently losing money. However, it has grown revenue at 33.81% over the past year, which is obviously a strong growth. If a company has negative cash flow, that alone is not a very good sign. But with that said, let's scroll down. We can see that Sasol has a very good forward dividend yield of 6.1%, but dividends alone won't necessarily make it a good investment. If you want to focus on dividends, I would say park a lot of your money in a good high yield savings account because there's basically no risk. It has a very good payout ratio, and then we have a free cash flow payout ratio that is very bad. When we scroll down, we can see that Sasol has a good financial health score with their current ratio, which is 2.1, which is good. They have a very good cash runway, which basically means they have a lot of time before all of their cash runs out. So they have enough money to cover debt and all of their short-term liabilities. Next, when we go down to growth, it shows that it has very good revenue growth. Like I mentioned, it had revenue growth of 33.81%, which is great. Its gross profit is increasing. its operating income is increasing and its net income is increasing. But then we see the operating cash flow is decreasing by 31.54%, which is very bad because at the end of the day, we want to see a company building their free cash flow. We can also look at their profitability, and the gross margin, operating margin, and net margin are all average. But then we go down to our free cash flow margin, which is in the minus, and that is very bad. Management overall, I can't really comment on the management. We can see though that the 5-year stock growth of minus 55.4% is below the S&P 500 of 58%. So that is obviously very bad. It means that if you invested 5 years ago, you are losing quite a bit of money. So I'm going to go up and show you guys the financial part of Sasol. When we look at their revenue, I'm just going to zoom out a bit. We can see that their revenue is at an all-time high of around 275 billion rand. This seems great because we can see that they are growing their revenue year over year, and this is a really good sign that the company is still growing. But unfortunately, revenue alone won't necessarily make it a good investment. We can scroll down and look at their net income, which is around 38 billion rand. So if we look at the income statement, this looks pretty good because they are actually generating money at the top line and the bottom line. I want to show you guys the cash flow statement quickly, and I personally like to look at free cash flow. And if we go to the quarterly results, we can see that in the last quarter, Sasol has lost around 12 billion rand in free cash flow. Obviously, quarter over quarter, it might be that the previous quarter they had around 12 billion rand in free cash flow, and now that 12 billion rand is gone, probably gone to debt. If we go to the yearly amount, we can see that they have 17 billion rand in free cash flow. Next, I just wanted to show you guys the freeform tool, and this is where we can compare the revenue to the free cash flow. So we'll compare the revenue of Sasol with the price to free cash flow. So here we can see that the revenue is increasing and is reaching all-time highs, but it shows that the price to free cash flow is decreasing, and at the moment it's 0 because they are not generating free cash flow. So although this might seem like a great company because it's generating revenue, a lot of it, unfortunately can't seem to generate enough free cash flow. So yeah, if you have been following the channel, you probably know that I bought Sasol quite a while ago and I sold it off for specific reasons. So I'll share that link in the description so you can definitely check that video out. Next, we have Sibanye Stillwater, and let's get started with this one. So again, we'll just jump to the inside tab. It has a inside score of 2.7 out of 5, which is again average. The quick blurb says that Sibanye has a negative free cash flow of minus 356 million rand, which means it's currently losing money. Also, it has a free cash flow margin of minus 0.26, which suggests it is not very profitable. These words says it all because we want to invest in profitable companies that can generate a lot of revenue, that can generate good net income, and can produce free cash flow at the end of the year. Let's just scroll down. At least we can see that the financial health of Sibanye is very good. The same as Sasol, they have a good cash runway, they have a good current ratio, their shares outstanding is decreasing, and its intangibles as a percentage of total assets is also very good. The problem with Sibanye is its growth, and I'll show you why in just a moment. So we can see that their revenue is decreasing. That is a bad sign. We can see that their gross profit is decreasing. That is another bad sign. Operating income, net income, and operating cash flow is all decreasing. Profitability again is not very good because it has a very low free cash flow margin, which is in the minus. When we go to management, again, I can't comment on the management specifically. I am not invested in this company, but we can see that the 3-year stock growth of minus 30% is also below the S&P 500. So I want to jump to Simply Wall Street to quickly show you the some key information about future growth. We can see that the earnings growth rate of Sibanye is around 4.2%, meaning that the consensus estimates is 4.2% growth for this company. If we go to our discounted cash flow model, we can quickly type in these numbers. We'll use earnings. Let's project it for only 3 years. The metric growth rate would be, let's make it a 5% instead of 4%. And we'll keep the shares outstanding at the same as it is at the moment. We'll use the forward price to earnings ratio 5.1. Let's just make this 5.1. And here we can see that the fair value of the stock is around what it is trading at the moment. So if we invest today at the current price, in 3 years time with these specific numbers that we put in, it will give you a compound annual growth rate of 9.71%. That is if we use this specific numbers. So let's just jump to the freeform tool and I'll show you the revenue versus its price to free cash flow. Revenue, we can see that it has been declining. And just have a look at the price to free cash flow, which has been dropping, and at the moment it is 0 again because this company is not producing free cash flow. The next stock we are going to cover is Renergen, and let's just type it in here. So Renergen is one of those stocks that received quite a lot of hype before. It's a micro cap company, so it's much different than the previous companies that we looked at. But let's just have a quick look at the blurb. Again, this company has negative free cash flow of minus 511 million rand, which means it's currently losing money. Also, it has a current cash runway of 1.31 months. The cash runway is the amount of time the business has as its current burn rate before it will need to take on debt or dilute shareholders to raise more money. If you don't understand this, this is not a good sign. It means that the company's financial health is not very good. The cash runway here we can see is 1.31 months, meaning that the company will eventually have to raise money or take on more debt. It has a current ratio of below 0.86%, and the current ratio is simply a popular metric investors use to compare the current assets and liabilities. A current ratio above 1 means the company has more current assets than current liabilities, and obviously below 1 means that it has more liabilities than current assets, which is a terrible sign. I think people fall in love with the company because of its growth rates. We can see that the revenue is increasing tremendously, the gross profit is increasing tremendously, operating income is increasing but very so slightly, net income is increasing, and operating cash flow is increasing. This is great. Because it's a micro cap, it still needs to make a lot of changes before it can become a profitable company. And this is when we see the profitability of the company, which basically shows average, very bad, very bad, very bad. So just remember, the way I'm sharing this information is to make it as simple and as easy as possible. And we can see that the company is unprofitable. So I don't like to invest in unprofitable companies, and I would suggest that you don't either. We're going to skip the income statement. I just wanted to show you the free cash flow. And if we click on yearly, we can see that it is losing 511 million rand each and every quarter. And just have a look at their track record. We can see that every year they are losing more and more money. It's scary. It's very scary. It feels like a very risky investment in my opinion. If we jump to the freeform tool again, just have a look at this. We can see that their revenue has skyrocketed, but still they don't generate any free cash flow. So obviously it's a micro cap. It's still trying to find its place, and it's not making enough money. So this is not something that I would consider. But what do I know? Because this is one of the most bought stocks in June. Then lastly, we have MTN. And this is a bit of an interesting one. So let's just go to our insights. It has a 3.2 out of 5 insight score, and it says that MTN Group has grown revenue at 13% over the past year, which is strong growth because it's double digits. Also, it has seen its diluted average shares outstanding decrease by minus 1.16% over the past year. So that gives us as shareholders some added value. When we go to financial health, we can see that the current ratio of MTN is 0.96%, which is below 1, which is bad. This, in my opinion, can change in the next quarter or in the next year, but this is definitely something to monitor and to consider when buying this company. Again, the shares is decreasing, which is great. The growth of the company, its revenue is increasing, the gross profit is increasing, the operating income is increasing, net income is increasing, and the operating cash flow is increasing ever so slightly. Profitability is pretty good with the gross margin of 72%, operating margin of 27%, and a free cash flow margin of 10%. It has a cash conversion of 113%. So let's just jump to its financials and let me just show you what I like to see. If I scroll out on these graphs, we can see that MTN has generated some all-time high revenue of 207 billion rand. If we have a look here, we can see that year over year, MTN is growing their total revenue, which is a great sign that it has a steady business. Obviously, operating expenses is also growing, but nothing too extreme. Then we can look at the net income, and we can see that the net income over the last couple of years has been growing as well. And let's just have a look at the current ratio. So we can see the current assets is 134 billion rand and the current liabilities is 139 billion rand. So that's why it has a current ratio of below 1, because its current liabilities is more than its current assets. Although it has almost 400 billion rand in assets, and its total liabilities is 275 billion rand. The current ratio can be a problem. This is definitely something that we have to look at going forward. I don't know how it's going to change, so we have to monitor that going forward. When we have a look at the cash flow statement, we can see that MTN is generating good free cash flow. We can see that over the last year it has been decreasing, but it is still a pretty healthy free cash flow amount. And that's really what I like to see, because you can use your free cash flow to either pay down debt or short-term debt, or you can use it to reinvest in your business or even pay for your dividends. And that's why MTN also pays dividends. So I'm pretty comfortable with this, and this is definitely something that I like to see. Just wanted to show you some of the metrics of MTN. Again, the current ratio over the last couple of years has been below 1. So this is definitely something that we need to monitor going forward. And just one last thing is its price to earnings ratio of 12, which is almost half of what it was last year. So this is potentially an undervalued company. We can see that the revenue is skyrocketed and the price to free cash flow is almost at 11, or let's make an average of 11. If it's below 10, it can be a clear indication that the company is undervalued, because it's generating free cash flow from all of the revenue that it is receiving. So with that said, this was the 5 most bought stocks on Easy Equities in June. I'm not sure how I feel about these companies. Let me know whether you feel they are good investments. If you had to choose one company to invest in, which one would it be? I can't tell you whether they will be doing good going forward. We can only hope so, and hopefully if you invested in these companies you can still make a lot of money and at least learn from your investments. If you like this type of video, I know it's really long, I know there's a lot of things that I said. If you liked it, let me know which stocks you would like me to analyze. I also do one-on-one sessions where I can help you to analyze and find good stocks to invest in. I can obviously share a lot more detail when we do a session like that, because there's so many things to cover. But hopefully this video can help you in some way. If it did, give it a thumbs up and comment down below.